Well, welcome to our latest episode of Capital Markets Cocktails. Today we have a great lineup of guests and a very important topic to discuss. And so first of all, let me introduce, I'm joined today by my co-host, Tyler Durr, who is a senior manager here at Lambert. And now let's introduce our guests. We have Gary LeBranch, who is president and CEO of the National Investor Relations Institute, or NIRI, as well as Ted Allen, who's the vice president of communications and member engagement at NIRI. So gentlemen, welcome. I wonder if you could spend a couple minutes and introduce yourselves and your backgrounds and why we're here today.
Well, first of all, thank you on behalf of NIRI. We're delighted to be with you today, and I love your podcast. And thanks for doing this. You know, it's in this time we're all so isolated. It's great to see other faces than the ones you're home stuck with. So I appreciate it very much. And thanks for helping us get the word out about this proposal. To answer your question, I'm the president and chief executive officer of NIRI, and I've been with the organization about 3.5 years now. And prior to that, I was chief executive officer of the Association for Corporate Growth, which served the private equity market. But my whole career has been working with and being CEO of associations all throughout the world, really. And it's a great honor to be with such a vibrant community as NIRI, and issues like this remind me how important it is that organizations like NIRI exist so that we can help make the capital markets fair, free, and transparent.
Absolutely.
Ted, I wonder if you could give us a little background on you.
Sure. Well, thanks again for inviting me to participate. As you mentioned earlier, I oversee communications for NIRI. I also oversee our advocacy efforts, including this work on 13F. I've been at NIRI since 2012. Prior to that, I worked at Institutional Shareholder Services, and prior to that, I practiced law and was a journalist. So, this effort has it's been very encouraging to see so many companies and so many IR professionals stepping forward to help us out with this effort, and we really appreciate your efforts to help us get the word out to the IR community and beyond that to the entire corporate community.
That's great, Ted. Thanks so much for your background. Now, first, let's get to the fun part, the cocktail, which is really why I'm here. And so this cocktail was actually suggested by Ted. It was his choice, and it was actually, I could not think of a more appropriate cocktail for the topic we're discussing today, which is called the Painkiller. And so the Painkiller is a rum-based cocktail that's sort of a cousin to the pina colada, and it's guaranteed to bring a vacation in a glass. And it's a specialty drink of the British Virgin Islands. And so it contains rum, orange juice, pineapple juice, a little creme de coconut, and basically you mix all that together in a nice shaker glass, which, given my martini background, I'm very familiar with. Shake it all up and pour it into your, now they suggest a hurricane glass, but I don't have any hurricane glasses, so I'm just using a very short glass of garnished with a nice pineapple wedge. So here's quick. My drink.
Jeff, what is a hurricane glass?
A hurricane glass is and I don't know why they call it a hurricane glass. I should know my trivia, but it's kind of like it's like the typical glass that a pina colada comes in. It's kind of shaped like a big bowl with a narrower edge at the top. And I suppose it got its name from, being something that you needed to drink during a hurricane. I'm not really sure.
Sure.
But at any case, so the Painkiller is appropriate for our topic today. So the topic is really the proposed SEC changes to the 13F filing requirements. And for a little bit of background on kind of where we are historically. So since the mid-1970s, the SEC has required that institutional investors that are managing over $100 million in assets to quarterly file all of their holdings with the SEC on Form 13F. And the reason this was a great step forward back in the 1970s was it allowed a lot of companies that may not have had great insights into their shareholder base to suddenly know who their institutional shareholders were. And this is at a time when, when there was an evolution in the markets where, we're evolving towards street name ownership and where you didn't have registered shareholders necessarily. So you didn't have that insight into who was on the books and records of your shareholder base at the transfer agent. You may have had just one or two shareholders that were large that, was at the time DTC, the Depository Trust Company, CDN Company, that would have been your largest shareholder. But they actually were just holding it on behalf of the beneficial owners who you wouldn't know. And so the 13F rules were really designed to help clear up that information and make it more transparent to issuers. So if you were a publicly traded company, you would have some insights into who your institutional shareholders were. And so recently, and this is going back to July, the SEC proposed a change in the rules. And so what they have proposed is raising that threshold from $100 million to $3.5 billion, which is a big jump. And I know it's been 40 years or so since they've actually implemented the original rule. But the interesting thing is that it's a change that the SEC is kind of attempted to say it's due to inflation and that sort of thing. Well, if you use traditional CPI inflation, that 100 million would be the equivalent of about 450 million in assets today, not 3.5 billion. But instead, the SEC has decided to increase that threshold by 35 times, which is based on Federal Reserve's estimate of how much the market has gone up in that period of time. Well, there's we can debate that whether or not that's accurate, but there's a lot of changes that have happened in the market during that time and the increase in number of issuers and all the rest that, for our perspective, this number doesn't make a whole lot of sense. What it would in effect do is eliminate roughly 90% of reporting entities from having to report their holdings every quarter. And so this is really taking a step back in terms of transparency and is one that I know we are opposed to. So Gary and Ted, I wonder if you could kind of give your thoughts in terms of what these proposed rule changes are and how NIRI looks at this and where you think we can do better.
Well, thank you. And you provided a very good oversight, summary view of exactly what the SEC is proposing. To dramatically raise the threshold to 3.5 billion is just without basis. You correctly stated that if they followed consumer price index, it would be 450 million. Which, by the way, NIRI had argued for an increase in the threshold to 450 million with some additional transparency and changes in reporting threshold. But let me just sort of say at the beginning that the proposal that we're talking about, this 13F proposal, literally came out of the blue. Normally the SEC throws up trial balloons. It has executives and commissioners on the doing speeches and saying things in public or in articles that give hints and raise the possibility gently that they might be doing something or thinking about something. And in addition, the SEC typically hosts roundtables and asks for comments on paper comments and other kinds of input to allow the community to have some level of input and contribution to ideas, especially an idea as broadly sweeping and controversial as this. Now, the other thing that the SEC does, like all similar agencies, is it has to publish an official agenda of things that they're working on. Not only was 13F not on that agenda publicly until the last minute, I'll come back to that, but we had met, NIRI representatives had met with the SEC, with executives of the SEC back in September of last year. We brought 60 members of NIRI to the SEC headquarters. That was back before, when you could bring people face to face and have meetings, BC, before COVID. And during that meeting, they avowed that they would have nothing to do with 13F changes. It was not on their agenda. And the official agenda of the SEC showed no efforts at all toward 13F. And then just a few weeks, a handful of weeks before the 13F proposal came out, we had an executive of the SEC participate in our virtual board meeting to sort of talk about changes in what was happening at the SEC. And we do this routinely. And again, nothing was mentioned on 13F. And then, lo and behold, the afternoon that the 13F proposal came out, the official agenda was suddenly changed to include 13F changes. So, and it was announced late on a Friday afternoon, which is the traditional bureaucratic way of keeping something pretty low on the radar screen, right, Ted?
That's certainly right. I mean, it was announced without an open meeting. It was announced in a press release that I think the SEC thought would be overlooked. It's rather ironic for a proposal that would significantly reduce transparency. It was released in a very untransparent way. So it's certainly, I guess, in keeping with their overall approach to this issue.
Sure. So I think
Gary, you've piqued my conspiracy theory, interest here. So I'm anxious to see, what else you might have known. But it strikes me that this is something that is almost the opposite of what the SEC was founded on. It was founded on transparency and openness of information, and this seems to be going completely in the opposite direction.
It's also completely contrary to Commissioner Clayton's often made comments about his goals of transparency. And that's what sort of took us so by surprise that after spending, much of the last 2 years talking about and advocating for more openness and more transparency, which we've seen in other ways, to out of the blue, without hearings, without comments, propose such a egregious reduction in transparency, because the net effect of the proposal would be to eliminate transparency to about 90% of the visibility of institutional investors to issuers. In other words, issuers won't be able to see about 89 to 90% of their shareholders, which is completely the opposite goal from a world in which we at NIRI and the SEC have been working toward more shareholder engagement, not less.
Right. So I wonder, kind of off of those statements, was there any sort of impetus for this change, for this timing? And then two, is there any rationale that they've expressed or, that you've kind of learned of in addition to, the inflation that Jeff had mentioned earlier?
Ted, go ahead.
Sure. I mean, we've heard various theories about how this emerged. I mean, as Gary mentioned, this sort of came out of the blue. It was not something that was considered by the SEC's Investor Advisory Committee or their new Asset Management Committee, which normally, would vet proposals like this and offer recommendations. From what we understand from talking to other Washington-based associations, is that this is something that emerged from the White House as a favor to campaign donors for the president's reelection campaign. And this was not something that, was really well thought out or was, the product of input from investors and public companies, the way that normal SEC rulemakings are. We think that the primary impetus and the primary, beneficiaries of this rule are going to be a handful of hedge fund executives who would fall just under the $3.5 billion cap, because many of those hedge funds will not maintain large equity positions. And the key thing about 13F is it only counts equity investments, not debt investments or other types of investments. And so the problem is that for a relatively small number of beneficiaries, it has a great impact on the rest of the market, and not just public companies. One of the things that's been very extraordinary with this rulemaking is just the level of oppositions from retail investors, from small asset managers, who have almost uniformly come out against this proposal. So it's certainly been astounding to see sort of the groundswell of opposition from investors as well. I mean, NIRI's been hearing quite a bit of concern from public companies. We submitted recently a comment letter that was joined by 237 public companies representing more than 2.9 trillion in market capitalization. We also heard from 26 IR counselors who joined our letter as well. Also other associations in town, including those representing insurance companies, hospitals, and REITs as well. So the level of opposition has been extraordinary, and we hope that the SEC takes notice and thinks and reconsiders the proposal, and and we hope they'll withdraw it and try again and take a more even-handed approach, an approach that may increase the thresholds to reflect inflation, but also improves transparency by reducing the current 45-day reporting period, which is a relic of the 70s. Most investment managers can report their holdings within a day or so after the quarter. There's no technological reason they couldn't do so. We think something around 10 or 15 days would be a reasonable compromise between the two. And we'd also like to see monthly disclosure, although that's something that we would need legislation to accomplish. And we'd also like to see the SEC require 13F filers to report their short positions, which is something that was required by the Dodd-Frank Act of 2010, but the SEC's never seen fit to implement that proposal.
That's something that you bring up, Ted, that's really interesting, because I know NIRI has advocated for a shorter time period and the disclosure of short sales for quite some time. And that's something that, again, it's, as an investor and as a for us as practitioners in investor relations, knowing, as a corporate issuer, knowing who owns your stock, who has shorted your stock, that's important. It's a great, that's one of the cornerstones of the capitalist markets that we live under is, companies have to be accountable to shareholders. And if you don't know who those shareholders are, that's going to be a problem for that. That accountability is just not going to be there. And I know one of the stated reasons that the SEC had proposed is that this would be a cost savings to smaller investment managers. Yet, I'm not sure how much they spend on 13F filings. It can't. To me, it doesn't seem like this is something that's tremendously expensive to do. I mean, heck, you could just take I can download my brokerage account holdings into an Excel file in 10 seconds, and that doesn't seem to me a huge cost or a huge expense or putting out of institutional holders to be able to do that. And I think that to me it seems that there is a striking lack of transparency with this that I think needs to be addressed.
No, that's quite correct. I mean, as Commissioner Allison Lee, who dissented from this release of this proposed rule, has pointed out, the actual cost for a 13F filer is probably less than $5,000 a year. The SEC has an estimate of $15,000 to $30,000 in its proposed rule, but she says that doesn't really make sense. And I think the actual cost is probably even lower once you're set up to make these 13F filings. From talking to lawyers who help their clients make these filings, it's like an hour or so of a paralegal's time to essentially review the list of an investment manager's holdings against the SEC's 13F list, and just double checking that and then submitting it to the SEC. So certainly once you're already making these filings, the cost of continuing to do so is pretty much inconsequential, especially if you're a large hedge fund with $3 billion in assets under management. Your cost for doing these filings is barely a rounding error based on the management fees that you're taking in each year.
Mm-hmm. So I do want to voice here that we at Lambert, echo the position of NIRI as it relates to this proposed change. We've signed the comment letter that NIRI distributed, and we've also put out a comment letter of our own and encourage clients to do the same. So, we've traditionally worked with micro through mid-cap companies and have done some additional research on this topic to better understand the potential impact on clients and just companies within that cap rate range. So we found that the reduction in number of files and transparency is disproportionately impacting these smaller companies. So I just wondered if NIRI had found this to be true as well, and kind of wanted to better understand your perspective on what actions as practitioners, as consultants to clients, and then as leaders of these issuers, what actions can be taken in advance of this proposed change?
Well, you're absolutely right. The companies that we believe will be hurt the most or most affected are small and mid micro cap companies. They're going to be disproportionately and substantially affected by this. Although the 237 issuers that co-signed our letter were among some of the largest in the United States. It was a long list of smaller, mid-size, and micro-cap companies. But the community at large recognizes this. And, the larger companies will be able to figure out a way, and they're better armed, have better capabilities. Smaller companies won't, and it will make their lives more difficult. And as a result, we fear that you're going to see more activism, ambush activism, that will inevitably take out some of those smaller companies purely for the sake of making a few bucks for some hedge funds. Won't be any value added as a result of this process. It's just sort of doing the effort of taking some money out of the market, and at the expense of average retail investors. It was interesting that more than 1,000 retail investors have also issued comment letters to the SEC to oppose this, and that's a rare thing to see that many retail investors get so upset about a particular rule. So what can we do? Write letters to the SEC. The comment period ends on September 29th. And so we encourage everyone to write to the SEC, refer to the proposed 13F rule, and indicate your opposition to raising or increasing the threshold to $3.5 billion. You can visit the NIRI website. We have an advocacy or call to action website. And we have templates that you can use and adjust them for your own needs. Tell them your story, especially if you're a small or micro cap company. Tell them how this might affect your company directly and explicitly, and don't be afraid. There's the SEC asks for and encourages letters of all kinds, pro and con. And there won't be any blowback on your company. It's an important part. Everyone on the other side of these issues feel free to and throw their letters in. So the issuer community needs to step up and be counted in this effort as well. Ted, is there anything else that they can do?
Well, thanks for making the point about submitting comment letters. I just wanted to emphasize that you don't really even need a formal letter. You can submit comments, and in many of the retail investors, they have a comment box form that you can type your comments into and submit it that way. So the SEC makes it very easy for you to get your point across. And these letters don't have to be 5-page letters, simply a few paragraphs just noting how your company would be impacted. And a couple of things I wanted to mention in terms of potential pain points that you should emphasize in your letter. Many companies use 13F data to prioritize investor requests for meetings with the CFO or the CEO or your board members. And without 13F data the same way that we have it now, a company's ability to make these decisions as to who gets to talk to the CEO and the CFO will be much more challenging. Another pain point to consider and to mention in your letters is, for companies that are outside the S&P 500 index, many of them use 13F data to identify prospective investors for their outreach efforts, and also to assess their ongoing efforts to attract investors. Many companies have told me that they eagerly look forward to the next round of 13F filings so they can check to see if an investor they spent a lot of time courting, in fact, pulled the trigger and bought their company's shares. So a lot of that benefit of 13F filings will be lost if the SEC's proposal were to go through. And we also think it will chill the market for IPOs as well, which has been a priority for Chairman Clayton. If you're a private company, you know who all your investors are. Why would you go public and lose that transparency in this new world of lack of transparency for 13F filings? So we think these are all great points to make. In terms of comment letters, beyond doing those letters, if in addition to your own letter, both NYSE and NASDAQ are circulating letters that you can join into. I also encourage, if you're active in an industry association, to let your association know. We've had numerous discussions with groups like the Edison Electric Institute and other groups like that to educate them about this issue. And by dropping a line to your association that represents your particular industry, I think will be very helpful. And finally, if you do submit a comment letter to the SEC, I encourage you to send a copy to your senator and to your U.S. House delegation as well, just to make sure they're aware of this issue too. Even though we doubt that Congress would have the bandwidth to pass legislation on 13F this year, even an inquiry or two from your senator or from your House member to the SEC might cause the SEC to think twice about trying to rush this proposal through before the end of the current presidential term. So many ways you can help, but as Gary mentioned, now is not the time to sort of sit back and let others advance the cause. We need everybody to step forward and to share their views about why this is such a bad idea, because this is certainly something that I think is the most significant negative change in recent IR history that would impact public companies and the ability of investor relations practitioners to do their jobs each day.
Ted, you raised a great point. If you think about it, we've done some analysis on some of our clients, and some of our smaller cap companies, they're potentially going to lose 40% of the visibility into their shareholder base. And that's a significant impact for a company that, is already, maybe smaller and has greater challenges attracting institutional shareholders. To suddenly not be able to see who 40% of your institutional shareholder base is tremendous. And for any issuers out there, I would encourage you to take a look at your, last quarter's 13F filing report and sort it by assets under management and get rid of all of those that are under $3.5 billion and see what you're left with. Because that's going to be the impact that this change could have on your visibility into your shareholder base. But I guess in the interim, we need to focus as IR professionals on continuing to do what we can to make sure that we, are proactive and can continue to reach out to shareholders to maintain those lines of communication with our existing shareholder base, and to really, continue that sort of forward momentum that we've had. That we may have had previously, because that's going to help us as we try to navigate through any potential changes that the SEC might make here.
Well said.
Absolutely. Well, I think that brings us kind of to the close here. So let me sign off with a cheers. We've talked pain points, we've drank painkillers, but this certainly has been the opposite of a painful experience chatting with you both today. So thank you again for joining us, and cheers.
Cheers.
Here, here.
Stay well, everyone.
Yes, you too. Thanks.
Cheers.